Okay, we are back. I'm very happy to be talking with a fellow who was a serial entrepreneur since childhood. Then he became a hedge fund manager and retired at 35. We're talking to Todd Tresidder, who is now running a really cool site called Financial Mentor. And he has some advice, which, well, frankly, Todd, I kind of want to ask you about. One of the specific pieces you talk about is kind of your radical move to retire young, in that you saved a huge amount of money. Am I getting the story right?
Yeah, you absolutely are.
So how much money were you able to save every year, or were you trying to save every year?
Oh, it was the way it works actually is percentages of income, right? So because your financial independence is a function of your spending level. And so I was saving roughly 70% of my income, which at the time I was a hedge fund manager, I had a middle six-figure income. So it just wasn't that hard. I still lived a very nice lifestyle and just banked a large amount of it. And the math is very simple. I've got a post on my site about how anyone can retire in 10 years or less. And it goes through the math of how if you can save a high percentage of your income, you can be financially independent relatively quick.
So you're kind of living on rice and beans. And then, so ultimately you can really live the good life.
Yeah, quite the opposite. It was easy for me just because I had a high income, right? You can still do it on a lower income. You just have to become an extreme frugalist. But either way, the way it works is when you can save a high percentage of your income, you can be financially independent relatively quick. The higher the income, the less you have to turn to rice and beans. So I lived a comfortable lifestyle, but not lavish. It wasn't, I wasn't an extreme frugalist, but I wasn't wasteful either.
So what did you do with the money? Let's say at the end of the year, you put away your 70%. What did you put it into?
Well, I ran a hedge fund, so I was one of the early pioneers of developing mathematical risk management systems for the financial markets. It's something that you get at MIT PhDs are doing nowadays, but back then I was an early pioneer in the industry. And so I had investment methods that I employed the money in the paper asset world. And then once we sold the company and I was financially independent, I did venture out into real estate and began buying apartment buildings as well.
So that was sort of an income play. But a lot of what you talk about is for people to manage their own money. Is what you did something you think that other people can be doing, saving money and then putting it into a hedge fund?
Well, I didn't put it into a hedge fund. I ran my own money. I just used methods that I developed for the hedge fund. And the answer is, yeah, anybody can do it. Particularly if you go to the real estate side is very intuitive. The paper asset side of the business is, paper assets I use for the term stocks, bonds, mutual funds, REITs, ETFs, that kind of thing. Yeah, anyone can do it. But the paper asset side is counterintuitive. It works more from a mathematical and statistical standpoint. And so it can be a bit deceptive for the average person to do properly. Whereas on the real estate side, it's very intuitive. I mean, everybody knows what's a good location, what is a good floor plan, what will live well, what won't in terms of rental housing. So it's something that really anybody's capable of doing.
Well, you're mentioning on two sides. One side is real estate. On the other side, you mentioned REITs. Discuss the difference between the two.
Well, REITs is paper real estate. If you're going to use it as a retirement vehicle, I'm an advocate of direct ownership of real estate. There's at least, I'm U.S. centric, right? Coming from the U.S. But in common law countries, generally, there's tax advantages to direct ownership of real estate. You also have the leverage advantages of mortgage financing. And so there's very different aspects to owning real estate directly as opposed to owning it passively through REITs.
But isn't the benefit of owning it through REITs is that you get professional management? You don't have to, fix someone's toilet in the middle of the night, as well as diversification?
Well, you can have all that with direct ownership too.
Mm-hmm. It seems to me, I'm not a real estate kind of guy, but I see that there are some people who seem to be experts in it. I don't think never seems as, seems easier said than done. And you watch guys who are very good at it. And then there are people who are very poor at it. A lot of people actually lose money managing their own properties. Are there skills or personality traits someone needs to be a landlord?
No, the way I teach this is that all asset classes are valid. There's 3 asset classes for financial independence. You've got business entrepreneurship, real estate, and or direct ownership of real estate, and then paper assets. Paper assets historically are a more of a parking place for building wealth than a wealth building vehicle in and of itself. If you look at the data, most of the data shows that most wealth is built through business entrepreneurship first, and then real estate second. Paper assets are generally third. They're generally used to park wealth built elsewhere.
Got it. So it's just there are different assets for different times in your life or different purposes. We're talking to Todd Tresidder.
Okay, by the way, that's an excellent point you brought in, Doug. I just wanted to elaborate on it before you did that. Yes, you're dead on correct, and that's a point that most people miss out on, is the different assets. There's no right, wrong. Each asset has a function and a purpose within your wealth plan, and you've got to match them to your goals.
Mm-hmm. Yeah, I think that is a big mistake. People sometimes read an ad, they go, oh, that looks good, and it may be good, but it may not be good for them. Let me just let people know who are tuning in now. We're talking to Todd Tresidder, who actually retired at 35 from the hedge fund world and now teaches people about investing. One of the things you teach, which I find kind of counterintuitive or counter what most everyone else says, is you say that buy and hold is a myth. And it seems that you buy something of quality, you hold on to it forever, and you say, hey, I'm like Warren Buffett. What's the problem with that?
Well, the problem is, if you want to be financially independent, if you want to live off your assets, there's a premise to buy and hold, which is you're supposed to accept market risk for a market-based return. And the problem when you accept market risk is it gives you an inordinately long time frame in order to realize the positive expectancy of the asset. So you'll hear commonly referred to, you've got to have a time frame of 20 plus years. The problem is the retirement planning research is unequivocally clear that your wealth, how much wealth you have going into retirement, is largely a function of your last 10 to 15 years of investment performance. And that's intuitively obvious, is because that's where you have the most assets. And if you get a double in that final couple years or the final 10 years versus your assets get halved in a bear market, that's going to make or break your financial independence. And then similarly, your safe withdrawal rate in retirement, once you do retire, is largely a function of the first 10 to 15 years of performance. And so what you really have as someone who wants to live off their assets is sequentially 2, 3, 10, 15-year periods. You don't have a 30-year period as traditional financial planning advocates. And so each of those 10 to 15 years periods have to perform, and buy and hold can't ensure that. And so I take the position that risk is something you don't accept blindly, but rather it's something that must be managed.
Is what you're describing in terms of retirement being in 10 to 15 year chunks, is that different from, let's say, how the previous generation looked at it?
Well, I can't address that. Where I'm at with it, Doug, is that planning for retirement now is very different from how the previous generation planned for retirement. At least in the U.S., we had pension plans that were, you worked for 30 years for a company and then you had a pension plan. Now everything's gone to independent planning where you have 401ks and everything's self-funded. And then the other thing that's changed too is we've got increasing longevity. A lot of people will argue the longevity statistics based on the fact that it's really driven by the infant mortality numbers. But in fact, what we're seeing now is that longevity is increasing at the aging end of the scale now. And that's particularly true for people that are educated and have greater wealth. And so as you get increasing longevity, what happens is your money has to last longer. And that changes the equations as well, because you can't safely amortize a volatile pool of assets for much longer than about 20 years. And so a lot of people are looking at 30 plus year time frames on a volatile, and that changes considerably. So yeah, it is different. It's a different ball game.
So if people are thinking of it a little bit differently, it means that they're probably repeating, as we often see, many of the mistakes that their parents made and the problem is, of course, their parents might have had a fixed pension that they were able to live on. But now what you're describing is that people have to take care of themselves, and that can be scary if you're planning on, if you say, well, I'm a long-term investor, my advisor told me to invest long-term, and really it just doesn't work that way. Is that the problem?
Well, yeah, I mean, if you're going to be a buy and hold investor, you have to be able to accept 50% drawdowns on occasion. We've had 2 rounds of that in the last, since 2000 here in the U.S. And so that's part of the buy and hold strategy, is large drawdowns. And the problem is not that those drawdowns occur in short periods of time, but rather that they create what I call flat spots of 10 years or longer. In other words, the drawdown itself occurs rather rapidly, and then the market digests, comes back, goes back down. And we've seen that since 2000 here in the US. And when you do that, and let's say you're using the 4% rule, and you're spending 4% from your portfolio, if you go 10, 15 years without investment performance, let's use 10 years as an example, your portfolio is going to be down 40, 50% just on the spending alone, not to mention, volatility effects of that spending. The market will come back, just as buy and hold advocates say, but your portfolio won't. And so, these are very real problems. And I don't know anybody that goes through a bear market living off their portfolio, goes through a drawdown 40, 50%, and it doesn't change their life. And that's something that, people don't commonly talk about, but it's very real. And so the idea of living off a volatile portfolio and accepting market risk is something that a lot of people just don't understand very well.
I think the expression that I'll often use when people talk about that is I'll say, the phrase to add insult to injury. So the injury is if the portfolio drops, the market goes down, and then the insult is you're pulling money out so that by the time the market actually recovers, you don't have anything really left in the market to recover with it. So the average annual return is in fact a little bit of a myth when people just apply it to their investing. They say, if the market makes 6% every year, I believe I can make that. That means if I only took out 4% every year, I'd be fine. And the way you're describing it, that's not really true. What are some other misconceptions you think people have about retirement planning?
Well, it's the word retirement in and of itself is a misconception. People look at retirement, when you think of retirement, you think of an old person reading novels or playing golf or sitting there having an umbrella drink on a beach. And really, retirement is nothing more than a euphemism for old age financial independence. And the truth of the matter is you can have financial independence at any age. I had it at age 35. I'm 55 now. That's given me 20 years of life to create whatever I wanted to do with my life. And so I think what people really want to do is shift their thinking about all this. The math is true of retirement planning, whether you retire at 35 or 55 or 65 or whatever it is. And you really want to change your focus to how can I achieve financial independence at any age? Another one that I throw out is the idea of that retirement is about amassing a bunch of assets, right? We always have, how much money do I need to retire? The whole premise is you got to amass this massive pool of assets that you then amortize down because you're going to work hard for 40 years like a dog, and then you're going to scrimp and save, and then you're going to do nothing of substance for the remaining 30 years of your life while you're retired. And that's a myth. You can look at retirement more on a cash flow basis. And this is more than just semantics. What it does is it fundamentally changes how you approach the investment equation, and it changes all the math of retirement when you start looking at it from a cash flow basis as opposed to an asset accumulation basis.
Yeah, I think that's very important to realize that it's not just about how rich you are. It's about how you set up the money so that you can pay the bills every month, because the goal is to be able to support yourself throughout all of your retirement years, whether they are young retirement or old retirement. Todd, I see we are just about out of time here, but in the last few seconds, tell us, how can people learn more about you and the work that you're doing?
The site is financialmentor.com. That's financialmentor.com, all one word. And that's my hub. That's where everything is. So you can find the social media accounts from there and whatever else you're interested in. I give away a free mini course called 52 Weeks to Financial Freedom, and I give away a free ebook for everybody that subscribes.
All right, we will put a link to that at the show notes of today's show. Todd Tresidder, thanks so much for your time.
Thanks for having me on the show, Doug.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.